Fearless Disease.
All right, so let's talk a little bit first about this big deal. It's only about a week rather, since it's been announced, but it's been possibly years in the making given some of the trends that we've seen in the actively managed ETF market, Brian. So why Goldman Sachs Asset Management and why Innovator Capital Management, and why is it a good tie-up?
Yeah, well, you talked about it. Goldman Sachs is really committed to our asset and wealth management business. Our asset management business in particular, $3.5 trillion asset manager. We're the 8th largest asset manager in the world. We're top 5 public active. We're top 6 in private alternatives. But as we think about the major trends that our clients are talking to us about, it's in the active ETF space. And so we have this leadership position in public active, but we know we need to deliver more to them in that way. And so we've got our active ETF business that we've been building for years now. We're really proud of that business. We're going to continue to invest in that. But to accelerate us down that path, we did this deal with Innovator. We've loved that business for years. We've known the founders. We've known the team. We're really excited about this space that they've invented, the defined outcome space. And so when you brought all those pieces together, it really just made a ton of sense.
How much?
FearlessDisease fam, today we expose the truth they hate to hear, like right now, if you are ready. As you hear, Goldman launches ETFs for downside protection amid volatility. Big bet on hedges as S&P hits record highs. S&P did hit record highs, and it's awesome that the CEO or one of the chairmen here at Goldman Sachs are going into ETFs. So they put a lot of money. We're looking at $2 billion within that ETF firm. It's an awesome move, and it's going to be big moves for them next year.
Of this story for Goldman Sachs GSAM, Goldman Sachs Asset Management, going after Innovator, is driven straight up by the demand for these types of products. We've been talking about buffer ETFs, defined outcome ETFs for some time, but this seems to me like a very big bet on the future of these types of instruments. So what exactly is the maybe main driver, if you will, for what happens?
So if you think of the identity of Goldman Sachs Asset Management, we focus on the really kind of sophisticated area of the markets and solving those problems for investors. So whether that's direct indexing, whether that's evergreen alternatives, or whether that's active ETFs, that all kind of lives in the same neighborhood for us. And so we think the entire active ETF space is interesting, but defined outcome in particular is a very fast and attractive space to us. It's solving particular problems for investors. They're looking for income, they're looking for downside protection, they're looking for further growth. And it's kind of on this critical path of innovation that's happening in the marketplace right now, where more and more investors are using defined outcome ETFs in their portfolios. And so it was incredibly complementary to our identity as an asset manager. And it was also at this really exciting point of the growth curve of defined outcome ETFs, which we think could 4 to 5x over the next 5 years.
This is a big deal for sure.
Of course, it's very true, and I think what it's going to do is going to embrace for them tariffs, or it's going to be able to help with shocks from inflation. This is a good move because you want to just not have your money all the way in that liquid cash. You want to be able to spread it around with the ETFs, Bitcoins, everything like that, because the tariffs, of course, making it a bumpy road for other investors and other companies, and it's going to be bring up that inflation in the future. So you want to be able to diversify your money, and this is also what Goldman is doing. They have to move with the times. The future is here, AI is here, Bitcoin's here, ETFs are here, so they have to move with the times.
Independent, investment advisor's perspective, Nick, when you take a look at some of the products that are out there from ETFs and how they've evolved, these defined outcomes are basically something that maybe more advisors are starting to look more closely at right now. Are you one of those types of advisors? And just how much do your clients on the high net worth or ultra high net worth side of things want to use these types of products as opposed to other wealth management strategies that have been in place for decades at this point?
Yeah, for instance, these have, as you mentioned, existed for quite some time, whether it be in the structured product arena, whether it be in option overlays within investment portfolios. We think there's both a client demand for these. We also see a role for them in portfolios. The way we kind of categorize many of these, and for us, it's really coming at the angle from equity exposure with downside protection built in is oftentimes how we're thinking about these. And we fit these more in what we call a risk-aware growth bucket, where it's enabling our clients to have access to public equity markets, but with some measure of systematic downside protection built in.
How much, Nick, from your perspective, do you think about using these types of products in the ETF wrapper cookie cutter is not the right way to look at it, but it becomes packaged, right? You have a product that you can buy right off the shelf, and it does the things that you want to do, as opposed to having a separately managed account for a client that then you actively put options, overlays, or hedging type strategies in place to enhance or try to get the same kind of outcome. Which is the more desirable outcome for you?
It'll depend client by client, situation by situation, as do many things in investment and portfolio management. We look at the cost side as a consideration, and there's the operational ease. Obviously, the ETF vehicle, the operational ease side is infinite there in terms of being able to have same holding, same portfolio construction across a multitude of clients and manage that scalably. On the cost side, right, as competition is intensified in this space, right, the costs are very much reasonable, and oftentimes what we see is in line with what you're looking at within the SMA space. And so, generally speaking, we have plenty of clients where we do option overlays on top of separately managed accounts. We also have model portfolios constructed of ETFs, leveraging many of these types of defined outcome strategies, as well as other risk managed equity strategies.
The interesting part about this.
Very good response. Very good response. And one thing he says, it varies. It's always going to vary depending on their portfolio and their visions for their companies. But my prediction so far, from hearing this and going on until 2026, I think ETFs are going to hit at least 10 billion in flows by like I said, by Q1 of next year, at least up until maybe about February, guaranteed. Because the volatility is going to keep spiking. It's either you're going to protect or you're going to miss the dip. So you might as well just go ahead and buy once it hits that dip, and that's where we're at right now. Smash a like, tap the next video on the screen, subscribe, hit that bell. The CashApp FearlessDisease is always in the description if you are rocking with the movement. See you on the next one. Stay rich and stay fearless.